Welcome to the Deep Dive. Today, we are wading into a topic that touches nearly every American household, whether you are trying to buy, sell, or maybe just watching your biggest asset sit completely still.
We're talking about the U.S. housing market.
Exactly. And the number we're going to start with is, well, it's absolutely shocking. It defines the state of the market in a way that, prices alone simply cannot.
It really is the defining statistic of this moment, which is why we're diving into the source material you provided. The current U.S. real estate market is operating at a historic low turnover rate.
And that rate is just 2.8%.
Just 2.8%. It's an incredibly low number.
2.8%. I really want you to just sit with that number for a moment. We talk endlessly about market crashes and booms, about price increases and decreases. But this number, it describes the activity.
Or, more accurately, the profound lack of activity.
Yes. We are talking about market paralysis, where the gears have essentially seized up. And for absolute clarity, when we say turnover rate, what are we actually talking about?
It's simple. It's the annual percentage of existing homes that actually change hands, that get sold.
And at 2.8%, that means, what, fewer than 3 out of every 100 homes are sold in a given year?
That's it. It's a tiny fraction.
Okay, so to contextualize that data, we need to compare it to what's considered normal. What's a healthy market look like?
Well, that's where the number really becomes stark. A typical, a functional real estate market operates with a turnover rate somewhere in the 5 to 7% range.
5 to 7%.
That's the range that gives you fluidity. It provides options for buyers, and it allows for that crucial mobility for sellers who need to relocate for jobs or, family needs, things like that.
So we are at less than half of the absolute bottom end of normal?
Way less. And the source material really emphasizes that this 2.8% rate isn't just low. It's the lowest rate we have seen since the early to mid-1990s.
Wow.
We haven't experienced this level of fundamental market inertia, this stillness in 3 decades.
That is incredible. It confirms we're looking at a deep structural problem, not just some, temporary seasonal dip.
Not at all. This is systemic.
So knowing this data is our starting point, what's the core mission of this deep dive today? We have this dense, insightful source material detailing exactly why the gears of the housing market have seized up.
Well, our mission is to really unpack that complex interplay of economic factors, the undeniable mathematical pressures, and the profound psychological hesitancy.
Fear, basically.
The fear, the risk-averse behavior, exactly, all the things that have created this market inertia. We need to go into extensive detail on the specific forces that are trapping both buyers and sellers, effectively leaving them frozen and just sitting on the sidelines.
So is the deep dive into how we reach this unusual state of, a stagnant equilibrium?
Exactly. We're analyzing not just what the problem is, but why it is so incredibly persistent.
Okay, let's unpack this. We have to start with the biggest force holding the whole system still. The sources are crystal clear on this. The central mechanism driving the lack of inventory is something called the lock-in effect.
Right. And this focuses squarely on the existing homeowners.
This is the primary driver behind that shocking 2.8% turnover rate.
Absolutely. The lock-in effect is, it's identified as the cornerstone of this stagnation. It's not just an abstract concept. It's a powerful, almost unavoidable financial trap that's built right into the current interest rate environment.
So this is all about the people who already own a home.
Exactly. For existing homeowners, particularly those who bought or, refinanced in that golden age of ultra-low rates, let's say between late 2019 and early 2022, they secured mortgages often below 3%.
Some even lower. I know people with rates in the low 2s.
Oh, absolutely. And that's the key.
And the moment they decide to sell that house, they are voluntarily giving up what is essentially the most valuable financial asset they own. And it's not the equity in the house.
No, it's the debt.
It's the low cost of their debt.
Precisely. We really need to look at the detailed financial example that's provided in the source material, because this is where the abstract concept becomes brutally concrete and, frankly, incredibly painful.
Let's do it.
Okay, so imagine you are a homeowner today. You have a 3% mortgage rate on a substantial loan, and you need to move. Maybe for a job, maybe you have another kid.
A normal life event.
A totally normal life event. You now face the daunting prospect of taking out a new mortgage. That new loan is going to be priced at current market rates, which are sitting, potentially in the 6 or 7% range.
Or even higher, depending on your credit profile on the day.
Right. And that jump is just astronomical.
Yeah.
It is crucial to analyze not just the nominal rate change, but the actual cost to your wallet every single month.
Okay, so let's run the numbers from the material. Give us the real-world impact.
So we're looking at a $400,000 loan, which is a very common mortgage amount in many parts of the U.S. The jump from a 3% rate to a 7% rate on that $400,000 principal results in a substantial increase in monthly payments. How substantial are we talking?
We're talking nearly $1,000 more per month.
$1,000.
Just think about that. Over the course of a single year, that is $12,000 in additional interest cost for the exact same amount of debt. That is the unavoidable financial cost of moving.
And the deeper dive into the numbers here shows something really interesting. It isn't just that it costs more over 30 years. It's that it costs more acutely in the early years of the mortgage because of how amortization works.
Yes. This is the insight a deep dive needs to deliver.
Right.
When you are paying a 3% mortgage, a much larger portion of your monthly payment goes toward principal repayment, especially after the first few years.
Yeah.
That means you're rapidly accelerating your equity accumulation.
You're actually paying off your house.
You are. But when you move to a 7% mortgage, especially in that initial decade, the vast majority of your payment is going straight to interest. It's just servicing the debt. You're building equity at a much, much slower rate.
So not only are you paying $1,000 more per month,
You're also effectively just renting the money from the bank for much longer. And this realization that you'd be giving up massive long-term equity building power, that's what truly locks sellers in.
that analysis really highlights the gravity of the decision. I mean, for many families, an extra $1,000 a month is not just discretionary spending. It's not your vacation fund.
No, not at all.
It is the difference between financial comfort and significant strain. It could jeopardize their ability to pay for necessities, for college savings, for retirement. It is a powerful, powerful disincentive that goes way beyond simple math.
It creates what the source calls a sense of financial inertia. We often think of financial decisions as purely rational, spreadsheet driven.
Right.
But this situation introduces a profound psychological impact. Giving up that 3% rate feels like throwing money away. It feels like accepting a massive permanent pay cut, even if you sell your current home for a profit because of appreciation.
Why would you give up a guaranteed 3% loan for a 7% loan?
Unless you absolutely had to. That's the key.
That emotional tax on the decision is huge. You hear people talk about golden handcuffs attached to their home.
That's exactly what it is. And this psychological barrier is why the material refers to this as discouraging selling unless absolutely necessary.
Okay, so what about those situations where selling is necessary? Are those sales even happening? I mean, who is actually selling a house right now?
Well, the only sales really happening at any volume right now are what we call distress or necessity sales.
The 3Ds, right? Death, divorce.
Death, divorce, and DIPL, or job relocation. A major job relocation without remote options or severe family changes that necessitate a different type of home. The discretionary moves, though.
The move-up buyer.
The move-up buyer looking for a bit more space, the downsizer looking for a smaller yard, those are the transactions that have just vanished from the market. They're gone.
And that collective reluctance, all driven by this desire to preserve these low borrowing costs. That is the engine that stalls the entire market.
It's the structural cause of the scarcity. Because these potential sellers are staying put, the normal flow of available properties, the existing inventory, it just dries up dramatically.
Creating a huge bottleneck.
A significant bottleneck, leading directly to that historic 2.8% turnover rate. And critically, it becomes a self-reinforcing loop.
How so?
Low turnover leads to low supply, which, as we'll get into, keeps prices from crashing. And those stable prices further cement the seller's decision to just wait it out. Why sell into a tough market if you don't have to?
Okay, so if sellers are locked in, we have to look at the other side of the equation. This brings us to the second section, the buyer's perspective. If there's no inventory, why isn't demand through the roof, forcing prices so high that sellers just have to move?
That's the paradox.
The answer lies in the buyer's hurdles, and it's a big one. The affordability crisis and this crippling uncertainty.
Right. So we transition from the seller's dilemma, which is the supply constraint, to the buyer's predicament, which is the demand suppression. Potential buyers are facing this dual challenge that makes housing fundamentally unaffordable for a growing segment of the population.
What are the two parts of that challenge?
First, they are dealing with elevated home prices. The lingering effects of the previous highly competitive seller's market when prices just soared.
The hangover from 2021.
The big hangover. And second, they're hit with those significantly higher mortgage interest rates we just discussed.
So it's not just high rates on normal prices or high prices on low rates. It's the worst of both worlds.
It is the perfect storm of high prices and high rates hitting the consumer's wallet at the exact same time.
And this combination creates what the source calls a substantial barrier to entry. Can we quantify that for you, the listener? Let's talk about debt to income, or DTI, ratios.
Yes, DTI is everything here. DTI determines how much debt a bank will allow you to take on relative to your monthly income. It's a hard and fast rule for lenders.
And it's getting harder to meet.
Much harder, because both the principal, the price of the house, and the interest rate are high. The required monthly payment to service the mortgage has just skyrocketed.
How does that translate into a real-world financial requirement? What kind of income do you need now?
The median household income required to qualify for a mortgage on an average-priced home has increased by over 50% in just the last few years.
50%.
Think about that. That pushes qualification requirements far out of reach for middle class, and in some high-cost areas, even upper-middle-class buyers. The required DTI is simply too high for most people.
So unless you have a massive cash down payment to shrink that loan amount,
The banks won't touch you.
and compounding that financial pain is the erosion of savings. It is not just the monthly payment that is the struggle. It is even getting the down payment together in the first place.
Right. Persistent inflation has been eating away at household budgets and savings for a long time now.
So every dollar you save is worth less.
Exactly. Think about the buyers saving for a down payment over the last few years. Every dollar they managed to save bought less at the grocery store, less at the gas pump, less for daycare. This continuous financial pressure means they have less money left over at the end of the month to contribute to their down payment fund.
Inflation is effectively reducing their ability to accumulate the necessary upfront capital.
It is a devastating double whammy, isn't it?
It really is.
Because inflation not only shrinks their savings pool, but it also drives up the Fed's interest rates, which in turn makes the eventual mortgage even more expensive.
It's a feedback loop of pain.
It really is. And this financial pressure requires buyers to make a larger down payment just to keep the monthly payment manageable enough to meet those strict DTI requirements.
So it becomes an impossible mathematical equation for many people.
It does. You need more savings, but inflation is making it harder than ever to save.
Okay, now let's layer on top of that the psychological burden of economic uncertainty. If I'm a financially responsible person, I'm seeing my savings erode, I'm seeing the interest rate jump, and the thought of taking on that much debt becomes, well, terrifying.
And this is where buyer hesitancy becomes a crucial part of the story. The financial landscape is dominated by a pervasive sense of economic uncertainty. People are genuinely concerned about job security.
You see high-profile layoffs in the news all the time.
All the time. Recession talk, general unpredictability in the global economy. So committing to the single largest, most long-term debt of their lives, a 30-year mortgage in that environment, feels incredibly risky.
But if inventory is so low, shouldn't buyers be acting out of panic? A fear of missing out that prices will never drop? Is there any data that shows this wait-and-see approach is rational, or is it purely fear-driven?
That's a critical challenge and a great question. Historically, low inventory creates panic buying, FOMO. But today's buyers are, I think, a bit more informed. They understand the lock-in effect and the DTI crisis. They are betting that the current situation is fundamentally unsustainable.
So they're waiting for something to break.
They are. They are hoping for a substantial decrease in either home prices, which would lower the principal, or a drop in interest rates, which would lower the monthly cost. Their risk calculation is this. Staying put and renting is less financially damaging than buying at the peak cost and rate, only to see rates or prices fall next year.
So they're waiting as a calculated risk based on the belief that the system has to normalize eventually.
Exactly. Until one of those two things happens decisively, they will remain on the sidelines, which further contributes to the subdued demand we see.
It sounds like the current financial landscape is just extremely demanding.
It is. It is no longer a market where, moderate savings and a solid job history are enough to get you in the door.
It's a market that requires a kind of financial resilience that many people simply don't have access to right now.
It is. Entering the market today demands a robust income and significant savings resilience to absorb this dual shock of high prices and high rates. This inherent difficulty pushes homeownership further out of reach for a growing segment of the population.
Which ties directly into the demographic impacts we see.
It does. The market has become accessible only to the wealthy or those making forced, necessary moves.
That brings us perfectly into Section 3, where we look at who is suffering the most from this frozen market and how this weird, inactive state manages to sustain itself. It's time to analyze the disproportionate impacts and this odd, stagnant equilibrium.
When a market freezes, not everyone feels the cold equally. The current conditions put specific demographic groups under immense stress. Let's start with first-time homebuyers.
They're facing what's arguably the steepest climb in modern history.
I think that's fair to say.
This group is inherently disadvantaged. They lack the built-in financial cushion that existing homeowners have. They don't have equity to roll over into a new purchase. They have to come up with 100% of the down payment cash themselves.
Precisely. They face the dual challenge of saving for that necessary down payment, which, as we said, inflation is eroding, and simultaneously qualifying for these high-interest mortgages.
Their entry costs are entirely out of pocket, and the debt servicing requirements are immense.
And because they are often competing with highly motivated, cash-rich buyers or even institutional investors who can swallow the high rates, they are almost permanently priced out in many markets.
What is the long-term cost of this delay? The sources suggest it's more than just a few years of waiting.
Oh, it's potentially years and years of delayed wealth accumulation. The source suggests homeownership could be delayed by 5, 8, or even 10 years for this generation.
A decade.
A decade. And every single year that's delayed means a lost opportunity to build equity through appreciation and a lost leverage against inflation. For this group, the journey to homeownership isn't just difficult, it's a massive wealth inhibitor.
It pushes them further into rental markets where costs are also increasing.
They are caught in a financial vice. There's no escape.
Okay, and then we have the move-up buyers. Now, they have equity, which you'd think would solve their problem, but they are also trapped. They are facing what the industry calls the trade-up trap.
They are absolutely subject to the same lock-in effect, but their stress is different. It's a different flavor of being stuck.
How so?
Well, they've built up significant equity from their existing low-rate home. That's the good news. But then they look at the cost of the next house, the trade-up property, and they realize the math just doesn't work.
Because of the new mortgage rate.
Exactly. The difference between their old 3% payment and their new 7% payment on the larger loan for the new house is so massive that it completely negates any financial gain they made on the sale of the old home.
So they might have $200,000 in equity, which sounds amazing. But if using that equity means their monthly payment jumps from, say, $2,500 to $5,000 a month.
The quality of life benefit isn't worth the massive increase in financial strain.
They can't afford their own success.
That's a great way to put it. They may find themselves unable to afford a new home that meets their needs. Maybe they need more space for a growing family, or they need to relocate to a better school district, all due to the overall higher combination of prices and interest rates.
So they're financially stuck where they are.
They are, and they're often forced to spend money renovating their current home rather than moving, which again further contributes to that low 2.8% turnover rate.
This combination of trapped sellers, creating low inventory and supply, and hesitant buyers, suppressing demand, results in what the source calls a peculiar market equilibrium.
It sounds like an oxymoron, doesn't it?
It does. A stable yet functionally broken market.
It's an inertia-based equilibrium. It is characterized by extremely low transaction volumes, which indicates market inertia, not vibrant activity. And this is so counterintuitive.
Because normally, if demand is low because buyers are waiting,
You'd expect prices to drop significantly to attract those cautious buyers and clear out the inventory.
but that's not really happening across the board. Why isn't low demand leading to crashing prices?
Because of the scarcity, the very thing we discussed first. That extremely low inventory driven by the lock-in effect acts as a fundamental price floor.
Okay, explain that.
Think of it this way. Since current homeowners have very low debt service, they have immense holding power. They are not forced to sell at a discount. They can wait.
They're not distressed.
Not at all. And because there are so few properties listed, even the reduced demand we're seeing is enough to absorb the available supply without forcing a steep reduction in price.
And in some places, it's still competitive?
Oh, absolutely. In highly desirable areas, the scarcity still creates bidding wars among the few financially robust buyers who can afford to pay cash or handle 7% rates.
So the price stability we're seeing is a function of supply scarcity, not market strength.
Precisely. It's stability for those already in the club, but absolute paralysis for everyone else trying to get in. The material stresses that this stagnant environment is simply not conducive to efficient market function.
The whole system feels frozen.
It is frozen. The mechanism of price discovery is broken because transactions aren't happening often enough to establish a true fair market value that reflects the current borrowing costs.
Let's synthesize these specific insights using the structured table points from the source, because that provides the clearest picture of this weird dynamic.
The structured insights offer a perfect summary of the internal contradictions of this market. For example, the historic low turnover rate of 2.8% is presented as an insight.
An insight? How is that an insight?
Because it indicates a stable, albeit inactive, market for existing homeowners. Their asset values aren't plummeting. But the challenge it presents is the significantly reduced housing inventory, which chokes market fluidity and limits options for everyone else.
Then you look at the seller lock-in effect. The insight is that homeowners are financially incentivized to stay put, preserving their low loan terms and guaranteed wealth.
But the fundamental challenge is that this single decision, multiplied by millions of households, drastically reduces the supply of homes available for sale. It contributes profoundly to the market stagnation and the overall economy.
Right. And on the buyer side, the clear challenge is high prices combined with elevated mortgage rates, making homeownership unattainable for large swaths of the population.
Yet, an insight is that the few transactions that are occurring are highly considered and strategic. You're seeing fewer impulsive buys and potentially more financially secure buyers in the long run.
And finally, the market equilibrium. It offers the stability of low inventory, preventing drastic price drops, which is a strength for existing owners holding appreciating assets.
But the overarching challenge is the stagnant market itself, low transaction volumes that impact all these related industries, and slow overall economic growth. It is clear the strengths benefit the few, while the challenges impact the many.
That's the structural inequality inherent in this 2.8% market. And that leads us directly into Section 4, the ripple effects. Because the implications of a hibernating housing market extend far beyond individual transactions. They impact the entire economic ecosystem.
Creating a significant drag on overall economic activity.
The housing market is a massive driver of economic activity. It is interconnected with construction, retail, finance, local government, everything. When it stalls, the drag is systemic and immediate.
Fewer home sales mean a direct slowdown in numerous ancillary industries.
Let's go deep into these specific affected industries, because this shows how broadly that 2.8% turnover rate is felt across the U.S. economy. We can't just list them. We need to analyze the specific nature of the impact.
Absolutely. Let's start with construction. Fewer existing homes selling means less pressure for people to buy newly built homes. This leads to a massive slowdown in residential housing starts for single-family homes.
And that has a direct impact on jobs.
A huge impact on highly skilled and blue-collar labor jobs, framers, electricians, plumbers. Entire supply chains for lumber, concrete, and windows feel the squeeze. That leads to layoffs and decreased capital investment in those sectors.
Okay, what about home improvement? You'd think people staying put would renovate more.
It's a different kind of spending. The market shifts dramatically. Home improvement companies that rely on turnover, which is where the big-ticket kitchen and bathroom remodels happen when you move in, they are severely impacted.
So people are maintaining, not upgrading for resale.
Exactly. The spending shifts from large, discretionary renovations to necessary repairs. Fixing a leaky roof, replacing a broken furnace. The average contract value shrinks, which forces contractors to restructure their entire business model toward maintenance reliance.
Something our final thought will touch on.
It will, and the people who facilitate the transactions themselves are facing an existential crisis.
You mean real estate agents?
The entire real estate services sector, agents, inspectors, appraisers, mortgage brokers, sees transaction volumes plummeting dramatically. Their entire business model is based on volume and turnover.
When turnover drops from 6% down to 2.8%, that effectively cuts their potential business volume by more than half.
More than half. Agents are moving into rental management or leaving the industry entirely. It's creating a huge churn in a previously highly lucrative sector.
And finally, the flow-on effect to retail. Furniture, home goods.
When you buy a new house, you almost always buy new things. A new couch, new appliances, paint, landscaping services. When you decide to stay put for another 5 years, those purchases are delayed or just foregone entirely.
And that slowdown translates directly to reduced consumer confidence.
And decreased revenue for large retailers, which further slows discretionary consumer spending, a key component of GDP growth.
Now, beyond the dollars and cents, there are profound social and personal delays that result from this market freeze. Housing is fundamentally linked to life milestones.
It is.
And the freeze is essentially pausing large parts of life for an entire demographic.
It's the foundation for major life events, and the freeze forces painful delays in life planning. People are delaying starting a family because they can't afford the home with the extra bedroom or in the better school district.
They're delaying relocating for career opportunities too, right?
Yes, because the cost of moving cancels out the salary increase. This creates a severe problem of workforce mobility.
A geographic
A
mismatch.
huge one. Jobs are available where housing is unaffordable, and people can't sell their affordable, low-rate homes to get to the new job markets.
That geographic mismatch can stifle economic innovation and growth, not just personal careers. And there's a real dark risk here if the economic conditions were to worsen.
Yes, the material warns of a potential risk of increased housing-related stress and potentially foreclosures. If people who bought at the peak with adjustable or higher rates face a downturn in the economy, like widespread job losses.
Their financial stress can worsen very quickly.
Exactly. The margin for error is much smaller when you are servicing debt at 7% than at 3%. This could lead to an unwanted increase in distressed supply hitting the market. That's scenario B, the hard landing, which we'll discuss next.
Finally, let's look at the long-term systemic concerns this low turnover raises for society as a whole.
The societal risk is perhaps the most serious implication here. It's the prospect of a lost generation of potential homeowners.
What does that mean?
If young people are consistently unable to enter the market and build equity, if they are renting during their prime wealth-building years, a fundamental path to middle-class wealth creation is blocked.
And that perpetuates and potentially exacerbates wealth inequality.
It does. Those who secured their low-rate mortgages continue to build generational equity, while those outside the market fall further and further behind.
And the effects reach local government funding. Property taxes are the lifeblood of many communities. They pay for schools and local infrastructure.
Local governments heavily rely on property tax revenue, and while existing property values might stay high due to low inventory, low turnover creates a specific municipal finance problem: delayed reassessment.
How does that work?
Many local governments rely on frequent sales to accurately update neighborhood property values for tax purposes. If homes aren't selling, the tax base can become structurally outdated, leading to budget shortfalls for public services like schools and infrastructure maintenance.
A frozen housing market is essentially freezing local community development.
That's a perfect way to put it.
That paints a comprehensive picture of pervasive stagnation.
Mm-hmm.
So what shifts the dynamic? This brings us to Section 5. Future scenarios and strategies for navigating this frozen landscape. What are the two main pathways out of this 2.8% turnover rate?
The dossier outlines two main and very opposing scenarios that could shift the market equilibrium, though both carry inherent risks and have very different timelines. The first, and the one everyone is hoping for, is scenario A, normalization.
This is the soft landing scenario, right? The controlled thaw, where that 2.8% number starts creeping back up towards maybe 4%.
It's the hope for a gradual, controlled thaw. Normalization involves a gradual reduction of interest rates, driven by shifts in monetary policy as inflation is confidently brought under control.
So the Fed getting what it wants.
That's right. The hope is that once the Federal Reserve signals sustained rate cuts and 10-year Treasury yields drop, mortgage rates will dip back into a more manageable range, maybe 4.5% to 5.5%.
Which would alleviate the severity of the seller lock-in effect.
It would. The financial penalty for moving decreases, so more people might be tempted to sell.
What are the signals that you, our listener, should be watching for to know if we are heading down this path?
Look at the CPI data, specifically core CPI and the Fed's dot plot. We need to see sustained confidence from the Fed that inflation is permanently subdued. But critically, this thaw will be slow.
Why slow?
Homeowners locked in at 3% are not going to rush to sell at 5.5%. They'll wait for 5% or 4.5%. It will be a years-long process of gradual inventory increase, which makes this the preferred but very lengthy scenario.
What's the alternative, the path nobody wants to see?
The alternative is scenario B, downturn. This is the hard landing. A significant economic downturn, potentially triggered by persistent uncertainty, a collapse in the job market, or some kind of financial shock.
And this would force sales.
It would force sales due to widespread job losses or severe financial hardship. We're talking about distress sales. This would increase supply very quickly as people can no longer service their debt, and it would almost certainly lower prices significantly.
But unlike normalization, this increase in supply comes at a massive social cost.
Absolutely. This comes with the risk of broader economic instability, an increase in foreclosures, and a painful return to negative equity for many. While it solves the inventory crunch and affordability for some cash-rich buyers, it's a consequence of widespread pain. It's the scenario policymakers are desperately trying to avoid.
The source also mentions the potential for policy interventions to try and nudge the market away from these extreme scenarios, to avoid both prolonged freeze and the recessionary crash.
Yes, policy interventions could play a vital role in stimulating activity without relying on either a painful recession or an endless wait for the Fed.
What would that look like?
It could include things like government-backed mortgage rate buy-down programs. For example, using models similar to FHA or VA loans, the government could subsidize a portion of the interest rate for first-time or specific demographic buyers.
Dropping their effective rate down to, say, 4.5% for the first 5 years.
Exactly. That would directly address the DTI problem for struggling first-time buyers, or targeted affordability initiatives specifically aimed at helping with down payments or closing costs. These policies aim to inject liquidity and activity precisely where it is currently lacking, at the entry point, to give the market a necessary controlled push.
Okay, moving on to the practical advice for market participants who are navigating this stalemate. Let's start with strategies for sellers in this reduced buyer pool. If you must sell now, how do you succeed when turnover is so low?
The sellers who succeed must acknowledge the diminished buyer pool and the heightened affordability sensitivity of those who are left. Strategies must focus on making the property exceptionally attractive.
What does that mean in practice?
It means focusing on essential, non-negotiable upgrades. Not trendy renovations, but ensuring the roof, the HVAC, and the foundational elements are flawless. You want to eliminate any and all buyer objections.
And the pricing strategy needs to be aggressive, right? You can't afford to test the market in a 2.8% turnover environment.
Competitive pricing is crucial. You cannot afford to be aggressive with your list price when the buyer base is thin and financially cautious. Sellers often need to price slightly below the last comparable sale in the neighborhood to signal seriousness and capture that limited pool of active, qualified buyers quickly.
And what about creative financial strategies, since the cost of debt is the core problem?
Sellers are increasingly advised to offer creative financing options, most commonly seller concessions.
What is that?
This means the seller pays for some of the buyer's closing costs, or even buys down the buyer's mortgage rate slightly for the first year or two. While the seller takes a small hit on the net sale price, say 2%, they are directly addressing the buyer's core affordability problem.
It makes the transaction mathematically possible.
And helps them secure the sale far faster than hoping for a generic buyer who can handle the full 7% rate.
Now, for buyers who are waiting on the sidelines, what are their strategies? The material advises patience and adaptability.
Patience is key because attempting to time the market perfectly is always risky. And adaptability means exploring alternative financing options outside of the standard 30-year fixed rate.
Like what?
For example, considering adjustable rate mortgages or ARMs if they are confident that rates will normalize within 5 to 7 years and their income is stable enough to manage the potential adjustment.
That is a high-risk strategy, though. It requires a lot of confidence in that normalization scenario we talked about.
It does, which is why the real key is financial resilience. That means optimizing their credit score to get the best possible rate and ensuring their emergency fund is robust enough to cover at least 6 months of housing expenses and job uncertainty.
And changing expectations about the ideal home, too.
Absolutely. Buyers must expand their search areas to more affordable regions. The sources highlight that many are now looking further afield, accepting longer commutes because the cost difference is just too great.
And considering fixer-uppers.
They should also consider properties that require renovation. While this introduces risk and upfront cost, these homes are typically discounted and offer a path to build equity over time. You're capitalizing on sweat equity rather than paying the premium for a turnkey house.
So the fundamental advice, which echoes throughout the source, is the need for personal financial discipline and a realistic outlook.
It is crucial. Buyers must prioritize their personal financial goal saving effectively, maintaining job security, managing debt over trying to perfectly time the market. The low turnover rate is a symptom of these deep economic pressures. Strategic thinking and a realistic assessment of your individual finances are the only way to successfully navigate this uniquely challenging period.
Regardless of which scenario ultimately plays out.
Exactly.
That brings us to our conclusion. This 2.8% turnover rate is much more than just a statistic. It's a macroeconomic symptom of a market that has chosen paralysis over pain.
It is a profound reminder of the intricate connection between housing markets, broader economic conditions, specifically high-interest monetary policy reacting to inflation, and individual financial decision-making. The combination of the seller lock-in effect and the affordability crisis has created a market that is fundamentally stuck in a stagnant equilibrium.
Navigating this era requires careful consideration, patience, and realistic expectations for all participants.
Absolutely.
The reality is that while the housing market is frozen, life isn't. People still need to move, to retire, start families, change jobs. And if that 2.8% turnover rate persists while interest rates remain elevated, the structural issues we've discussed, the geographic mismatch, the DTI crisis, the stagnation, are not going away quickly. This stagnation could be the new normal for a long time.
That's the critical takeaway. This stagnation could fundamentally reshape related industries.
Which raises a final provocative thought for you to mull over. If low turnover continues to suppress transaction volume for, say, the next 5 years, how might the industries that depend on property turnover, specifically the home improvement and construction sectors, have to permanently restructure their business models?
That's a huge question.
They can't rely on a constant stream of new buyers doing big renovations. Do they shift entirely from transaction volume dependency to becoming heavily focused on maintenance, preventative repair, and ensuring existing homes simply last longer?
The focus becomes preservation.
Exactly. That shift itself could profoundly alter the labor market and consumer spending habits for years to come, forcing an entire segment of the economy to prioritize preservation over rapid exchange.
A fascinating implication. If the market is frozen, the economy must pivot to maintaining the ice rather than shipping it away. Strategic thinking is now required across the entire ecosystem.
Thank you for sharing your sources with us and letting us do this deep dive into the frozen housing market.
A pleasure. Stay strategic out there.